I'm your host, Effie Pilarino, and I have the great pleasure today to be in a wonderful company of a fintech lady from Hong Kong, Helene Li. Welcome, Helen.
Hello, Effie. Hello, everyone. Delighted to be joining this discussion with you, Effie. Thank you for having me.
Now, for our guests, Helene Li is the co-founder of Go Impact. She comes from the traditional financial world with a very long career. I met her in the last 5-6 years when she was at BNP Paribas. She left about 2 years ago, I believe, to launch Go Impact. And of course, we'll be talking about the vision and the activities of Go Impact. What I want to mention is that Helen ranks very often in the company of other major influencers in the sustainability space, in the impact space, with Helen Clark, the former New Zealand Prime Minister, with Melissa Fleming from the United Nations, with Dr. Jennifer Williams, the director of Take Action. So Helen is one of those wonderful ladies that are also involved in the Fintech Association in Hong Kong. So I think the short introduction leads to handing it over to you, Helen, and tell us really your vision about Go Impact.
Thank you, Effie. It's really an honor to be mentioned together with all those illustrious names. And I think, what drives me to start Go Impact after a long career in banking, as you said, that spans from a Wall Street giant to, as you mentioned, BNP Paribas, was really the momentum that I see among asset owners, because I was working in private banking most of my career. And I hear a loud and clear message from the asset owners that they would like to shift a significant portion of their portfolio into investing sustainably, and not just into a green bond here and there, but really having, an offering, a portfolio that makes sense, that drives financial return, as well as making a positive impact with the capital that they, have on hand. However, there are still lots of disconnects. If we look at it, investing sustainably have not really been easy. So starting Go Impact was really envisioned to be a platform to, make impact made easy. And that's really, in a nutshell, sustainable investing. I think ESG can mean so many different things to so many different people. There are lots of myths that have to be clarified. But I think, for me, to put it really short, briefly, sustainable investing is about investing in a future you like to live in, or your future generation like to live in. So, whether it be environmental, social governance, it's really investing in that future you like to see and to be part of.
It's very interesting because this really, in my mind, requires a paradigm shift where, there's no silos between where we grow our financial wealth, whether it's small or big, and how we live our life and what our principles are. Because in our generation, there was clearly a disconnect. And when we were talking about alpha generation and so on, we were really only focusing on the strict financial aspect and ignoring anything else. Where do you see this paradigm shift right now? Where is it in its evolution? Have we just scratched the surface? And I'm not talking about investing. I'm talking about, as you said, the capital owners, the mindset, the paradigm shift.
Okay, that's a very interesting question. I think there are two aspects to that. Before COVID, okay, and right now the situation with COVID still being unfolding in various parts of the world. Why do I say COVID is like a watershed line because COVID has been a big accelerator. And also it exposed so many of the cracks we have in our systems that we really forced us to look at, this paradigm shift that you were talking about. Because before COVID, various people can still hide in a comfort zone or stay in a comfort zone. This is how I've been doing things. This is how my business have been running for so many years. Sustainability is very important, but I really don't see that happening anytime very soon in terms of, my portfolio. But hey, look, COVID, all of a sudden, nobody anticipated the extent and the seriousness of this. It has really forced everybody to look at, is my portfolio sustainable? Are the companies that I'm investing in, are they actually sustainable? Because apart from the environmental, social, and governance, the ESG impact, it has an impact on my financial return. It has an impact on my portfolio's return. So it makes sense for me to revisit all that very closely with a different set of lens, okay? With not just a traditional set of lens that looks after quarterly returns, that looks after chasing the yields, really at the expense of everything else. Everything else comes secondary. So I think COVID has really been a big accelerator in that. If you look at the inflows into ESG funds last year, it really peaked, it was like something like 30–40% compared to the year before. Why? The reason is not because all of a sudden people are waking up to the fact there is ESG. There has always been a lot of talk about ESG, but I think people are moving from the marketing to the mainstream, finally. ESG was a marketing agenda. It was a very useful and convenient marketing agenda at conferences, at forums. It's a good agenda for any financial institution to be associated with, okay? But whether you can actually adopt it, whether you can actually bring it to reality is another thing. So finally, I think we are seeing a momentum to shift it from marketing to mainstream.
It's interesting, Helen, what you're saying. I was looking at a report that looks at robo-advisors and performance, annual performance. It's a report by Backend Benchmark. And I looked at it as I do every year and looked at the main insights. And what was very interesting is that obviously all robo-advisors, especially in the US, the big ones, they included ESG portfolios in the model portfolios that they offer. But what was interesting is that is where the performance came from. So basically, if you looked across the board, whether it's the Morgan Stanleys or the Betterments of the world, their performance in 2020 came mainly from the ESG portfolios.
Absolutely. Just to add to that, if you look at the indices, S&P 500 versus S&P ESG, in 2020, the S&P ESG have outpaced the traditional S&P 500 by as much as 3.8, I think, %. So that is a reflection of the kind of inflows, if you like, and the performances of the companies that have been filtered through an ESG lens. I keep saying ESG is not just financial return, it's actually also a risk mitigation thing, because you can mitigate risk by applying an ESG lens through your portfolio, that you do not invest in companies that are likely or building up to a scandal being erupted very shortly. You are likely to be able to avoid those investments had you built in an ESG integration into your portfolio, which is, I think, more and more what we're looking at. It's not the traditional exclusion. So I don't invest in ammunition, I don't invest in tobacco. It's more than that. It's really about ESG integration into your portfolio that will actually help to achieve, honestly, the funding gap that we see being talked about in achieving the 17 Sustainable Development Goals, the 17 SDGs by 2030.
And also, it takes us away from this mania that we have about unicorns and high growth companies, and shifts it towards what I would call the zebras, that are looking after the pack and also have a smoother long-term earnings or profits and sustainable growth in the practical sense. I
Absolutely. I think unicorns are pretty much a kind of, legendary animal. Whether unicorns really do exist or not is anybody's guess. No one has really seen a unicorn, except in the fintech industry. Maybe we label them unicorns. But I think more and more we're looking at camels, because camels are resilient. Camels can go through very tough period, very tough markets, go through a long period of drought, whereby maybe revenue streams are trickling in if you're lucky. And I think more we should be looking at that kind of resilience, building up that resilience rather than an exponential growth that might actually have create more problems in the longer run. It's again a longer term approach, Effie. If we look at it, instead of a quarter by quarter approach, I think many companies are shifting the lens to having a slightly longer term approach, that not just in chasing the quarterly results, am I sacrificing or causing issues for my shareholders and other stakeholders in the midterm.
Very interesting what you say. What I hear from you, Helen, is really what we as individuals, as people, are shifting. We are valuing, having this resilience as an individual, as a team in our workplace, as a community in our life. And we want to take this in our hands. So I see this spillover of all these social values that are forming and becoming, on the coming to the top of the hierarchy, spilling over to our investment behavior.
Absolutely. We call it value-based investing. And I think a lot of companies are also having a value-based approach in terms of their mission, what drives their business plan, and so on. Because I think everybody realizes, that you do serve stakeholders apart from just shareholders. So it's a stakeholder economy, not just shareholder economy. And you see the younger generation. I was doing a lot of next gen programs in my banking days with the family offices, whether from the ultra high net worth to the next gen on the main street, the regular people that we see. The value base for them is much more important. They are less likely to buy a stock in a company that has scandals around how they damage the environment or how they treat employees unfairly, or have questionable practices in terms of engaging labor or others. So we do see that shift happening. And I think the family offices that we work with in our fund and so on, that shift is happening from the next gen onto the senior, the senior gen. Because the senior gen obviously are the wealth creators. And there is a huge wealth transfer, as we all know, happening from the baby boomer or the older Gen X to the millennial generation, happening over the next decade. And the millennials are going to look at investing very differently.
Yeah.
They will filter through the value based. They will filter through a sense of responsibility much more. And I think in a way they are more ambitious because they want to do more with their capital than just generating more capital. They want to be achieving more with their money than just making more money. They want to be able to use that as a lever to maybe solve some of the planet's problems that we face. And we know a lot of that is fairly urgent. I mean, it's climate, for instance, global warming. We live with the consequences day in. I've never seen bigger typhoons and bushfires than we've seen in the past couple of years. So these are very warning signs that the planet, that nature is actually sending us. And I think this is something that probably both the tech as well as the capital side can converge to help to, drive it forward.
Helen, I'm seeing from my fintech lenses and quite a focus that I have on wealth management and capital markets. I'm seeing new software for portfolio optimization focused on ESG,
Mm,
which is a
mm,
signal that there is demand out there, as you are confirming too, from those that are managing capital at a large scale. But
yeah.
what about accounting? What is going on there? Because that, is a tail that can wag the dog also in public markets at least.
Very interesting you mentioned that, because I think one of the pain points in this is that for a long time, people complain about the lack of universally recognized standards in terms of disclosure, which actually is a pain point if you want to mobilize capital at scale, because investors are less likely to invest massively into things that they simply don't know how that benchmark against their other investments and so on. So I think recently the IFRS, which is the global accounting standards body, have reached out to the industry in a consultation paper for which Go Impact have already responded in terms of trying to work on a set of global standards for financial reporting and financial disclosure around sustainability. Which actually, if you look at it, it would be good for IFRS to try to take a lead in driving this. They have long been established as a global accounting and financial reporting standard body. And I think this is probably a move in the right direction so that, we hopefully can look forward to better standards for investors to be able to apply to.
Yeah, and of course, more transparency in general, which is in general a trend that we see in fintech that is unstoppable. It's just a question of at what granularity will it get to, especially in the ESG sector. Helen, I mean, as you said, ESG not only is subjective, but it's very broad. It's about, the environment. It can be about people, the team, the employees, your customers, your partners, your supply chain, and so on. What have you seen over the past year? Where have you seen more focus, more concern, more interest in terms of impact? Is it energy, for example? Is it, how you treat people? Where?
Okay, I need to answer that question by two layers because on an investor education level, and Go Impact is very much driving that in a series of learning modules that are being rolled out across Asia Pac as well as the Middle East in helping the finance industry and family offices to better acquaint with this and what actually is out there. So they're case-based learning modules on different accreditation platforms that are being rolled out. On the investor education side, it's broad because people are interested in how supply chain sustainability can affect their investment portfolio. People are, of course, interested in climate, renewable energy, clean energy, what exactly is investable out there. People are also interested in healthcare. With COVID, I mean, public healthcare as well as private healthcare have really shot right up the agenda of priorities for a lot of people. So in terms of investor education, the landscape, it's actually quite broad. So much so that we actually grouped the 17 SDGs into 5 pillars in order to roll out the learning management system. But in terms of the funds, for instance, and we are launching one in Singapore shortly under the Variable Capital Corporation, the VCC fund structure. In terms of funding, we still see climate, energy, as well as health being the lower hanging fruits because for one simple reason, the urgency of climate and energy transition, it's really knocking on our doors. And I think it's easy for investors to appreciate that. And health, again, COVID has been a huge accelerator into channeling more of the capital, channeling more of the resources into this area in order to plug some of the gaps really that COVID has exposed for us to see. So in terms of the investment side, we do see those as lower hanging fruits. Does that answer your question a little bit?
It does, it does, it does. And it gives also a great leeway to hear more about the activities that you're doing through Go Impact as a platform and as an ecosystem. You already mentioned the educational aspect. Is that something that is offered at the B2B level? Is it a B2C offering? How does it work?
Right now it's at a B2B level because we believe in the lower hanging fruits are really the asset owners as well as the finance industry. Okay, so finance industry all need accreditation. They need to get the license renewed on an annual basis. So it's only natural that accreditation platforms would have something actually on the ESG learning in order for them to complete the accreditation that is needed. So that, it is what we're doing at a B2B level. But I think from a more massive adoption level, podcasts like this, kind of other channels that we see, they are also very effective occasions for people to be better informed, to see the latest trends, to see what exactly is happening. So I really believe that investor education is an important pain point that we are actually working to plug. In fact, that comes before the funds and everything, because the better informed the investor, the better they are to invest more, right? An uninformed investor will invest very little, if at all. So I think that's always been day one of our mission to try to do that as one of the key pillars of Go Impact, apart from the funds that we are offering.
And the funds that you're offering, are they publicly traded funds? Are they investing in publicly traded companies? Is it a mixture of private and public? Tell us a little bit more.
Yeah, because we actually are one of the first approved by the Monetary Authority of Singapore, by the MAS, as one of the first ESG Asia funds under the VCC structure. So under the VCC structure, you can have multiple funds within one set of constitution. So the first one that we launch is a listed equity fund, basically because we have a very good Nordic partner in our team. And as we know, the Nordic countries are really stellar examples of investing in ESG portfolios long before it becomes trendy. If you look at companies like Nordea and so on, where our PM and our partner comes from, they have long been invested in this and build out their own set of tools, if you like, to manage those portfolios. So we're actually leveraging that and trying to bring it to the public more through this first fund, which is a listed equity fund. But there'll be more to come, definitely.
Yes. What is there a focus, whether it be a regional focus, geographic focus, or thematic focus, or is it really just a broad mandate?
There is a geographic as well as thematic focus. The geographic focus is more Asia biased. I won't say that it's all completely invested in, so it's listed equities, but not completely in Asia, but with an Asia bias. There will be some from Europe as well. But also there's a thematic focus, obviously, energy, climate, and health are the sectors that this listed equity fund will primarily focus upon. And the good thing is, through the Nordic expertise, we actually are able to have a proprietary system to assess at least the net positive ESG impact of the companies we invest in. So the net positive impact could be in energy saving, could be in better, water, sanitation. It can be different aspects, but I think it benefits the investors to know that there is a set of tools, at least we are able to apply to the AUM that we are responsible for in terms of the net positive ESG impact that has been achieved in the AUM.
Thank you, Helen. And I think on this note, we have to wrap up. And I want to thank you for this great discussion and look forward to speak to you again and maybe meet in person in Hong Kong at the next FinTech Festival.
Yes, absolutely. Thank you so much, Evie. And, stay safe and healthy. And, thank you again for having me.